G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, we're going to be analyzing Tattooed Chef's first quarter 2022 financial results, and we're going to be going over what went well, what didn't go so well, and what we can expect moving forward. But anyway guys, make sure you like this video and subscribe to my channel. So before we go straight into the numbers here, I think it's important to remind ourselves on what are the key metrics that we need to follow to ensure that the investment goes well. And for Tattooed Chef, I believe there are two main key metrics. The first one is branded product revenue growth. We want to see that as high as possible. And then also margin expansion, particularly gross margin expansion, as I believe those are the two key factors in whether this investment turns out good or whether it turns out doing quite poorly. So anyway guys, revenue, it rose 37.3% to $72.1 million, and this is their highest ever quarterly revenue. And their revenue during the first quarter of pretty much each year is boosted by the fact that we're moving from the holiday season and a lot of sort of healthier alternatives get promoted at Costco. And as a result, Tattooed Chef end up doing a lot more sales at Costco compared to some of their other sort of streams. Tattooed Chef branded product revenue, it increased 21.2% to $43.5 million, or 60% of total revenue. And this kind of comes across as concerning on the surface because you would like to see the branded product revenue growing a lot faster than the revenue, well, what you might call the total revenue, which grew 37.3%. However, there is a fair reason for this. So Tattooed Chef have opened their New Mexico food facility, and also they've started to operate their facility in Ohio as well, which is going to be doing the bars. However, they're not doing branded products or significant branded products revenue out of these new facilities yet. At the moment, they're doing a lot of private label sort of manufacturing at these facilities. As a result, their private label grew a lot, whereas their branded product revenue grew less. However, over time, I do think these will flip, as Tattooed Chef do plan on transitioning these facilities from private label into branded product facilities, which of course will incur higher margins, which should help their gross margin over time. And if we look now at adjusted EBITDA, it was negative $13.4 million, and we had a net loss of $17.6 million. And this does seem quite high, and it was definitely higher than I expected. However, during the conference call, Stephanie, the CFO, did reaffirm us that there was a one-off expense in the first quarter. It relates to a marketing expense that they spent to get into the club, and it was, I can't remember the exact number. It was about 3 million. So if you take that off, that brings the net loss down a little bit. And they do expect this net loss here to be here in the first quarter. It's going to be the worst out of the whole year. So we should get reducing net losses going into the second quarter, then the third quarter, then the fourth quarter. And then the company also said that they expect to be profitable by the end of 2023. So this cash burn should end by the end of 2023. And if we now look into operational highlights, you can see branded SKUs. It rose from 78 SKUs to 90 SKUs quarter over quarter. So from the last quarter of 2021 through to the first quarter of 2022, which is pretty impressive. That's 12 new SKUs in one quarter. And they also added more than 10,000 new points of distribution. They commenced production of frozen, ready-to-eat Mexican food items, which is a huge market. The Mexican food market is massive, and hopefully they can make headway into that. And then also, they expect to complete their automation process in their factory. So this is adding in robotics to increase production, decrease labor cost, and that should in turn increase not only facility capacity but also gross margins, and they're looking to finish that by the end of 2022. In terms of operational highlights, branded oat butter bars are set to commence production in Q2 of 2022, and the company did say that these bars are not factored into their guidance or their revenue guidance for 2022, and they expect production of these bars to contribute a larger part of revenue in 2023. And also, cold storage facility operational. It should be operational in April of 2022, which is last month, and this will increase gross margins quite significantly. I remember they came out last conference call and they discussed that it will decrease their cold storage costs by about half, so that should be a boost to gross margins there as well. I think this highlighted quote here well explains Tattooed Chef's strategy to try to increase margins. So Sam Galetti on the conference call said, "We are advancing initiatives designed to leverage our increased manufacturing capacity and demand profile to drive efficiencies, reduce costs, expand margins, and enhance our competitive profile. These include increasing our retail footprint and product count in existing retailers, expanding our presence outside of the freezer aisle to include refrigerated and ambient products, and integrating automation across our operations. We commenced operations at our dedicated cold storage facility in April 2022 and expect to generate significant savings this year by bringing this capability in-house." So what we get out of that is we're going to get increasing margins from expansion out of the freezer aisle and into refrigerated ambient products, as these products have greater margins. We should get margin expansion from automation across the operations, and in this case they're talking about robotics in their factories, as this will decrease labor costs, increase capacity at the facilities, therefore increasing margins. And then also the cold storage facility, which obviously is going to increase margins as they're going to generate cost savings by bringing that capability in-house. And also as they just expand in general, there's going to be economies of scale where as they grow revenue, the cost of that revenue won't be as high as initially. So that should naturally bring some margin expansion there as well. So if we keep moving down, I think this is an important point here. So as we mentioned before, that 21.2% increase in Tattooed Chef branded products. Well, the reason why it didn't grow as fast as revenue was because of their acquisitions made in 2021, where in these factories that they newly acquired, they're not ready yet for Tattooed Chef branded products. So they are producing private label for now, and they intend on producing Tattooed Chef products sort of late 2022, early 2023. That's what they indicated on the conference call. And if we look here at cost of goods sold, we can see it increased quite dramatically, 41.1%. No surprise really, higher costs due to higher revenue, but also inflationary pressures, especially freight cost, cold storage expense, which will go down, labor costs. Obviously, labor at the moment is quite expensive. And then we did have a gross margin of 11.3%, which is well better than the last quarter where it came in at a measly 2%. And they're now within their guidance for the full year. And if we look at the financial condition here, cash and cash equivalents, we're at 57.4 million, and the company virtually has no long-term debt. Now, one of the questions that we got to think about is, will this cash get Tattooed Chef through to profitability? And I think it's going to be a tight one here. Maybe they might need to raise some debt or dilute the shareholders. It really depends when they become profitable. If they come, the company on the conference call did say they have about at least a year. So this cash here should last them at least a year. So it's going to be a tight one whether they need to raise money or not. However, if they want to make any acquisitions over the next 12, 18 months, they're definitely going to have to raise some money. In terms of outlook, so this is important. They reiterated their guidance on revenue. We're looking at 280 to 285 million in revenue, gross margins of 10 to 12%. So these gross margins should expand throughout the year, and we should have the highest gross margins in the later quarters of the year. Marketing expenses are continuing to push the brand. They're going to spend between $27 and $32 million on marketing, and thus far their marketing has proven to be quite successful. The brand is taking market share, and they are a leader, or at least top 2 in every one of the categories that Tattooed Chef is in. And in terms of product velocity, they're pretty much the best in the game here. And CapEx, they're looking at a spend of about 20 million, and this is into automation and robotics at their manufacturing facilities. And as we already mentioned, this should help drive margin expansion and just better efficiency moving forward in general. So guys, that's my wrap up for Tattooed Chef's earnings. I'd say overall, I can't be too mad about their earnings. These earnings were a lot better than the last earnings. They reiterated their guidance, which is nice to see. And I'm starting to lean towards maybe that they might beat these numbers, but we'll just have to see. We'll have to see what happens here. But anyway, guys, thanks for watching and have a good one.